Hey there, Jorge Montoya here with the Montoya Mortgage Team. And today we're going to talk about understanding FHA loans and whether an FHA loan is the right loan for you and your family. So having said that, let's jump right in. So first, let's answer the question, what is an FHA loan? Well, an FHA loan is the Federal Housing Administration, which is a part of the U.S. Department of Housing and Urban Development. Ultimately, FHA loans are insured by the federal government. Now, FHA loans are not just for first-time home buyers, which is a great thing. However, it is meant for home buyers that intend to occupy the property that they live in. FHA loans are a great option for those who don't qualify for conventional financing. And in a few moments, we'll talk about how to identify whether an FHA loan is better for you versus a conventional loan. Additionally, FHA is a good option to get started on your home journey. It's a good tool to get you into your home. However, it's not a loan that you want to keep for 30 years. We'll explain a little bit why in a few moments. Now let's talk about the down payment and closing costs required with an FHA loan. Now, your down payment actually depends on the credit score that you have. Even though it's very commonly known that you need a 3.5% down payment, in a few moments we'll talk about how your credit score actually has an impact and determines whether or not you can give 3.5% down. One thing that makes FHA loans popular is that monetary gifts from family members are allowed. Meaning if the down payment were 3.5%, the entire down payment plus the closing costs can be gifted, which makes this a very popular option for home buyers. Additionally, FHA loans can be used with DPA programs, down payment assistance. So for example, in the state of Nevada, which is where I reside, there's Nevada Rural Housing and Nevada Housing Division, which are two agencies that provide down payment assistance, and they pair up quite nicely with an FHA loan. So depending on which state you live in, your area may have a down payment assistance loan that can pair along with an FHA. Another thing that makes FHA loans popular are seller contributions. And in a few moments, we'll take a deeper dive onto how much FHA permits you to receive and negotiate from a seller to help you out with your closing costs. Now, I mentioned that we were going to talk about down payment and how your credit score affects your down payment. So 500 minimum credit score is what FHA will allow you to do, but that does require a 10% down payment. However, depending on the lending institution that you're working with, even though FHA will allow a 500 credit score, not every lender is going to be willing to go down that low on a credit score. For example, the company I work for, we will allow you to go as low as a 540 credit score and require the 10% down payment. So something really important, if you do have a 500 credit score, even though FHA allows it, the lending institution you're working with may have an overlay that does not allow them to go down that low. Traditionally, if you've got a 580 credit score, that's when the 3.5% down payment is allowed, which is what most FHA buyers end up doing, that 3.5% down. Another reason FHA is so popular is FHA is the most lenient mortgage. So when it comes to debt ratios, credit scores, negative credit items, employment history and or gaps, FHA tends to be very, very lenient, thus making it more easy sometimes to help home buyers qualify for the home that they're looking for. Now, we talked about FHA versus conventional a few moments ago, and here a 680 credit score and below is generally the ideal person for an FHA loan. If your credit score is above 680, that's when now a conventional loan may be a better option for you. But 680 and below, FHA tends to be the better solution for you. Now let's take a look at the overall credit activity. FHA allows accounts to be paid off in order to qualify. So to give you an example, let's say you've got a $500 car payment and you just don't qualify for the house that you want, but you have the ability to pay off that car loan. Well, we could tell the underwriter that you're going to pay that off as a condition of your closing, and that may give you just enough of a boost to help you qualify for the home that you're looking for. So that's a really cool option that FHA allows. Additionally, FHA is most flexible on medical collections, meaning that many times they're not going to ask you to repay them because they're medical. And of course, not everybody has medical insurance, right? So it's really nice to see that this program gives you the flexibility of not having to pay off some of those medical accounts. Now, when it comes to non-medical collections that are greater than $2,000, there's a couple of requirements that you want to be careful with. So number one, if you have a collection and there's a payment plan, then FHA will require for you to qualify with that payment plan. Or if that payment plan is affecting your ability to qualify, FHA will allow you to pay that off in order to qualify for the amount that you're looking for. Additionally, if you have a collection account and let's say there is no payment plan and it is over $2,000 in the balance, then FHA will require that we hit you with a 5% payment off of that $2,000 in order to get you the financing. But the nice thing about that is if we hit your debt ratios with that 5% of the balance, then you won't be required to pay off the account. So that's good. Let's also take a look at negative credit history. Now here we've got DIL, which stands for Deed in Lieu of Foreclosure, FC, which is a foreclosure, and then SS, which is a short sale. So depending on how old you are, short sale may be something that you may have not heard of, and we'll explain what all three of these are. So a deed in lieu of foreclosure is when you don't have the ability to pay your home mortgage anymore, so therefore you've decided that voluntarily you're going to return the home to the bank. Foreclosure, you didn't have the ability to pay off the home, you couldn't sell it, so therefore the home was foreclosed on and taken back by the bank. And then you've got the short sale. And a short sale is something that we've seen in the past. Let's say you owe $400,000 on your home and now the home's value is only $200,000, but you want to get out of that home. Then through a short sale, as long as the lending institution that has the financing, they may allow you to sell the home at the $200,000 value and forgive the $200,000 differential that there is. Now, if you're one of these families that went through a deed in lieu of foreclosure or a short sale, the nice thing with FHA is that after 36 months, after 30 years from the completion of these items, you'll be able to get FHA financing once again, so that's really good. Now, bankruptcy. Life happens to us all. So when there's Chapter 7 bankruptcy, if you are one of those families that this happened to, you are eligible for financing again after a 24-month period. So that's really good. FHA understands things happen, but one thing that to be really mindful of is that most underwriters are going to pay close attention to the after part, right? What happened after that 24 months? Did we reestablish credit? Are we demonstrating similar negative payment patterns, or are we showing now positive payment patterns? And then one thing that's commonly unknown about FHA loans is that when it comes to a Chapter 13, many families are actually able to purchase while they're in the Chapter 13 bankruptcy. Now with the Chapter 13 bankruptcy, this is where now you've negotiated with all the creditors and you've come up with a payment plan, a payment schedule in order to pay back the accounts that you owe them. And if we can demonstrate that you've had a 12 months of punctual payments and the court that's handling the Chapter 13 approves you to purchase a home, then now you can actually buy a home. For example, I've got a client now, they're in the middle of a Chapter 13 and they've been paying for about 1.5 years. However, the completion of this bankruptcy is not going to be for another 3-4 years. The good news for these families is that you don't have to wait for the completion. As long as you pay on time and as long as the court approves it, you can get an FHA loan prior to the completion of that Chapter 13, which is great. Now let's talk about rates. When it comes to rates and FHA loans, generally you're going to be looking at a 15 or a 30-year fixed mortgage, which is a really good thing. I'm a big fan of fixed mortgages because then no matter what happens in our economy, which you and I both know changes, your payment is fixed. However, depending on the lending institution, sometimes you're not limited to just 15 or 30-year mortgages. So for example, with our company, if you wanted to get, say, a 25-year note on your FHA loan, we could actually tailor that to the years that you wanted. So that's a pretty cool feature. Now, rates can be lower with an FHA loan and compared to conventional financing. And this is where a credit score becomes really important. So with FHA, generally, if you've got a 640 credit score, you're going to get the best rate possible versus a conventional. If you have that same credit score, the way they determine the interest rates, your credit score is a big factor, and therefore sometimes FHA with the 640 credit score will yield a much lower interest rate compared to a conventional. Now, one thing that has been very popular, especially this year, is the use of temporary buy-downs, which is something that FHA permits. Now, I will tell you this, temporary buy-downs are a blast from the past. This is not new. In my 17-year career, this is the second time I've had to utilize these options. So let me explain what a temporary buy-down is. So say that the going rate were 6%. If you're able to negotiate through your real estate agent with the seller of the home you're looking to acquire a credit to pay for closing costs, then you may be able to get what's called a 3-2-1 temporary buy down. And what this means is that if the going interest rate were 6%, then on year number one, you're actually going to get a 3% discount to that rate, meaning that year number one, you will pay a 3% rate. Now, what makes this very attractive is several things. Number one, your payments are going to drop dramatically, $400 or $500 per month. Now, I did say this is a temporary buy down. So here's what happens after year one. On year number two, your interest rate is going to go up by 1%. So year number two, you're going to be looking at paying 4%. Year number three, you'll go up to 5%. And then year number four and the rest of the life of the loan, you'll go back up to the regular market 6% rate, assuming that were the regular market rate. Now, a couple things to point out. This becomes a really good tool in a rising interest rate environment because now we can get you a 2 to 3 year window of reduced monthly payments. That way you can weather the storm of the rising interest rate environment and then eventually be able to refinance, and you may not even pay that 6%. So temporary buy downs are a very good use of financing in order to give you a break upfront on your monthly payments. Now let's take a look at mortgage insurance. Now, mortgage insurance is charged generally when you don't give 20% down. So not all home buyers have the ability to give 20% down, so it's very common whether you go with an FHA loan or a conventional loan to pay mortgage insurance. But there are a couple of things that differentiate FHA on the mortgage insurance versus conventional. So number one, FHA does charge you a one-time upfront mortgage insurance premium of 1.75% of the loan that you're acquiring. Now, this is one of those fees that you are allowed to finance within the loan. You have the option. You can pay it out of pocket or you can finance it, but most FHA buyers tend to finance it because it makes it a lot more affordable. Number two, you are paying a monthly mortgage insurance premium of 0.85%. Now, the monthly mortgage insurance premium stays there as long as you have an FHA loan. So one thing that does differentiate between FHA and conventional, like we show here, the MI does not fall off automatically at 20%. There was a time many years ago where you could actually remove the mortgage insurance on FHA loans, but that changed over the years. So currently, unless you give 10% down at the time of acquiring that FHA loan, that is the only exception where you could remove the mortgage insurance. However, you would need to pay at least 11 years on that mortgage and have that 20% equity in order to remove it. The likelihood of you having that FHA mortgage insurance for 11 years is not super high because, like I mentioned a few moments ago, FHA is a great loan to get you in, but it's not a good loan to stay in. So now let's talk about qualifying property types. In the beginning, I mentioned that FHA loans are meant for primary residence, meaning that you have to occupy the property as your primary residence for a minimum of 12 months. Now, after 12 months, if you decided that you want to upgrade your property and rent this one out, you are welcome to do so because you have satisfied that 1 year requirement. Now, the types of properties that are allowed are 1 to 4 units, which is something that makes FHA really unique. Because whether you buy a 1 unit, a duplex, a triplex, a fourplex, FHA still gives you the ability to do the 3.5% down payment, which is something that is very unique in comparison to conventional. Now, if you do go into that world where you're looking at a duplex, triplex, or fourplex, one thing that helps out many of those home buyers is that FHA does allow the use of rental income to help you offset the monthly payments and help you qualify, which is a great thing. Now, when it comes to condos are allowed to be financed by FHA as long as the condo association is approved by FHA. So depending on the area where you live, your condos may or may not be eligible for FHA financing. For example, here in Washoe County where I reside, there's many condo complexes, but there's only 2 that are currently actively approved. So if you are unsure, that's why you've got your mortgage professional and your real estate professional, so we can look these things up for you and help you determine whether that property is approved to go with FHA financing. Now, one thing that FHA does have when it comes to the property is what's called a flip rule. FHA wants to make sure that the current owner of the home you're buying has been in possession and has been the owner for the last 90 days. That's extremely important because if somebody's buying and flipping and reselling, FHA wants to make sure that when they're jumping in with the financing, that the home is truly worth the price that is being paid for. Now let's talk about the loan limits. This is one of the unique things with FHA. Depending on the area that you live in, the amount of money you can borrow, max money you can borrow, is really location dependent. So for example, here I've listed the loan limits that are in Washoe County. So if you were looking at buying a 1-unit property here in Washoe County, the max FHA financing would be $534,750. Now you can buy above that, but this is the max amount that FHA is going to be willing to give you. Now if you're looking at a 2-unit property, $684,550, a 3-unit property, $827,500, a 4-unit property, $1,028,350. Now the good news for you is that in the description of this video, I've listed the link. This way you can type in your state, your county, and then it'll tell you how much you can borrow in your independent county. Now additionally, this is something that is reviewed annually. So on this link that I'm going to share with you, it'll actually allow you to choose the current calendar year, which is 2022. And then come 2023, we will see what those loan limits are going to do, which at least in our area, we're seeing an increase in sales values. So it's expected to see FHA increase that max loan limit in many, many counties. But we will keep you posted on that. Now let's talk about appraisals, because an appraisal is required when it comes to an FHA loan. We want to make sure that the home you are acquiring and paying for is really worth what you're paying for. Now, one big thing with FHA is health and safety. We have to make sure that there's nothing hazardous, that the home is structurally sound, that the condition is good. And the appraiser is one of those people that goes out there, takes a look at the property, and they help us determine, us referring to the lender, determine whether that home meets FHA requirements, because not every appraiser out there is an FHA appraiser. It does take a different designation to be able to appraise and do an FHA appraisal. Now, to keep it simple, the property must be in move-in ready condition. It doesn't have to be perfect, right? But it's just got to be structurally sound, move-in ready. It doesn't have to be all clean and everything, but it just use common sense, right? If there's a hole in the ceiling, that's probably going to be called out. Now, one thing with FHA when it comes to appraisals is that FHA is more strict than conventional financing when it comes to the property condition. So some common items that we're going to list here that an appraiser will call out are things such as broken glass, chipping paint, any plumbing issues, exposed wiring, heating and cooling not working properly, rotting wood, moisture in the home. So these are some of the things that an FHA appraiser is going to look for. And if he happens to identify some of these things, he'll still complete the appraisal report. However, he'll mark it subject to completion. And then he'll give you a list of some items that need to be addressed. And this is why you have a real estate agent, right? Because then now they'll go talk to the seller, and hopefully you guys can come into an agreement and keep moving forward with the purchase of that home. So next, let's talk about employment, something very, very important. Generally, FHA wants you to have 2 years of employment history just to show that you've got a consistent and continuous income that is expected to move into the future. Now, the good news for you is that the employment can be with multiple companies, and this is something that we want to be very careful. For example, I had one client last year that had 9 employers in the 2-year period. Generally, that's not a good sign. That doesn't show lender consistency, right? You're bouncing around. However, this is where we act on your behalf, and it's almost like we're like your mini attorney, and the FHA underwriter is the judge. And if we can piece the story together the right way, then you can still get your financing, such as we did with this gentleman with the 9 employers. The reason it worked for him is because we went to every one of those employers and we were able to prove and verify that each employment was improving. So therefore, it wasn't just inconsistencies, it was the client seeking out improvement, more pay, more hours, more benefits, things like that. Now, it is ideal to maintain a similar line of work. The reason that's important, is because let's say you're working per hour, and then now you go into a job where your income is paid 100% commission. FHA is not going to like that because you don't have a history of earning commissioned income. And also, let's pretend you were working at a restaurant and then now you became an attorney. That's a whole different line of work. So ideally, you want to have a similar type of work. Now, one thing that we want to avoid is employment gaps. Generally, when FHA sees that you've had a 6-month employment gap or greater, they start questioning your income. And many times they will ask you to be back to work for 6 months in order to give you the financing on an FHA loan. Now, the good news for you is this. So let's say you're a student and you don't have any employment history, but you have been going to school, getting your degree, you graduate in whatever your career is, and then you start working in your career. The good news is that FHA will actually count your schooling history as part of your employment history. So that's a really cool and unique thing that FHA allows. Now, when it comes to debt to income ratio, let's take a look at that. There's the housing ratio, also known as the front end ratio. This is the calculation of your income versus the monthly house payment, and they do have a max of 46.99%. And then you've also got the total debt ratio, which is also known as the back end ratio. This is now the calculation of your new mortgage plus all of your other expenses that come up on your credit report, like your credit card payments, your car loan payment, your student loan payments. And then that max amount is 56.99%. However, I will point out, a few moments ago, I mentioned the word overlays. And depending on the lending institution that you work with, some companies do have overlays, meaning that even though FHA will allow these debt ratios, some companies may say, wait a minute, Jorge, with our institution, we're only going to let you reach a 50% max debt ratio. So even though FHA allows you to go higher, that lending institution may not let you go as high as FHA allows. The good news for you is that we are an FHA direct lender and we do follow whatever FHA says. Now, student loans. When it comes to student loans, FHA requires that you qualify one of 2 ways with this. One way is if there are no monthly payments, then we have to hit your debt to income ratio with 0.5% of whatever the outstanding student loan is. Or if you have an existing payment agreement, then we will just qualify you based on that existing payment agreement. No need to pay off these accounts. Now let's talk about manual underwriting, which is something that's really unique about FHA loans. Now, if you're someone that has non-traditional credit, which let me explain what non-traditional credit is. So if you've never used a credit card, you don't have a student loan, you don't have any car loans, then if we go and pull your credit, you're probably going to show a 0 due to lack of activity. So sometimes families will go prove that they are credit worthy through non-traditional credit. Some items would include, let's say you've been paying the rent on time, and then you've also paid electricity, and you also pay, let's say, water and sewer. If we can prove that those 3 items have been paid on time for the last 12 months, then now we've established non-traditional credit history, and FHA is okay with that. However, there are some limitations. With non-traditional credit history, they are going to limit your housing and back-end ratio to 31/43, which does have a significant impact on what you qualify for. So many times when I meet a family that's in this situation, we try to help them establish some traditional credit history, because you could see a big difference in the amount you qualify for because of these limited debt to income ratios. Now, if you've got a 580 credit score with compensating factors, then FHA will let you reach ratios of 40/50. Now let's talk about why you would need to go with the manual underwrite with a 580 and why you would be limited to these debt ratios. So when it comes to FHA loans, there's an underwriting engine that is run. It's desktop underwriting, or it could be LP, loan prospector. And as long as these decision engines issue an approved eligible response on your particular scenario, then now you can max out the FHA limitations. However, if it does not give you an approved eligible response, that's when now many families will try to qualify under the manual underwriting guidelines. So if you do go manual underwrite with the 580 credit score, you still will be limited to that 40/50 ratio. And if that's you and you don't qualify for the amount you want, it's not a problem. We'll take a look at your credit and see what we could tweak, what we could pay off in order to help get that decision engine to say approved eligible to maximize your purchase power, if that's what you were looking for. Now, let's talk about compensating factors, because like I mentioned, if you do a manual underwrite with the 580 credit score with a 40/50 debt ratio, that is allowed as long as you have compensating factors. So here's some compensating factors. So one would be proof of rent paid on time over the last 12 months, cash reserves, stocks, bonds, 401ks, just anything you can prove showing that you've got some reserves, 1 month, 2 months, 3 months. And also significant additional income not used to qualify. So here's a common scenario that I'll see. You've got your full-time job, but then maybe you've got a side hustle. Maybe you have a second job, part-time income, where you generate $200, $300, $400, $500 a month extra that is not being used to qualify. That is income that you are earning, and it is considered a compensating factor. Now let's talk about seller contributions. A couple years ago, seller contributions were a thing of the past. Demand was so high that there was no way that any seller was willing to negotiate with you to help you with a seller contribution. But the good news is that the market has completely changed, and now we're seeing more and more sellers open to giving you a contribution. FHA allows you to receive a maximum of 6% of your purchase price to go towards your closing costs. Now, one thing to point out, if you are one of the lucky ones that gets that 6%, let's say that 6% equaled $20,000 and your closing costs were only $14,000. Now we've got a $6,000 difference. You're not allowed to receive that cash back. So sorry, hate to break it to you, but you're not going to get a $6,000 check. However, we're really good at what we do. So we're going to help find ways to utilize that for you, for your benefit. And that can be done a few different ways. If the property has an HOA, maybe we can prepay some of the HOA. If there's enough money left, maybe we can do a temporary buy down or a permanent rate buy down to give you lower payments. So there are ways of utilizing that, but this makes FHA a very excellent program because now it allows you to get up to 6% of whatever your sales price is. Now FHA also comes with an option called an FHA 203K Rehab Loan. Not every property out there is perfect, and some properties may not pass the FHA requirements because they're a little beat up. Maybe the roof is pretty bad, and maybe the wall has a lot of damage, and maybe the seller does not have the ability to fix these things. Well, the cool thing is that FHA does have this FHA 203K rehab option that allows you to get a maximum of $35,000, which is allowed for repairs and rehabilitation costs. Now, to be clear, it is for repair and rehabilitation. We can't get you a pool. It's just not allowed. It's not meant for luxury items, but it's meant to help you purchase the home, still give the 3.5% down payment, plus on top of that, finance $35,000 to improve the home that you like, get you that roof that you need, fix the wall that you need, things like that. So that's a really cool option that FHA offers. Now let's talk about refinancing. One thing that FHA has that is really unique and really neat is they have this option called the Streamline Refinance, which you may or may not use. It just really depends on where the market's at. So one popular way that the FHA Streamline is used, which we have seen in the past, is this. Let's say you bought at a 6% rate, and maybe 6-7 months later, now rates dropped and now they went to 2%, which we have seen. FHA does what's called an FHA Streamline Refinance, and as long as you've been paying on time and as long as we can prove that the payment and interest rate will be better for you, you're allowed to refinance, get the lower payment, the lower rate. It is still a new FHA loan. However, the cool, unique thing about it is if you've been paying on time, there's no need to verify your income, no need to verify your credit. So that's a really cool option that FHA gives lenders to do and help you reduce your monthly payments. Now, earlier we talked about how FHA is a great loan to get in, but not to stay in. This is not the loan you want to keep for 30 years. So ideally, you want to go from an FHA to a conventional loan. That's really what you want to do. That's actually what I personally did. 2011, when my wife and I bought our very first home, we got in with this exact same program. 3.5% down. At the time, seller contributions we were able to get that negotiated. We received a $7,000 credit from the seller, which allowed us to come in with as close as possible to 3.5%. But then 3 years later, between our monthly payments and the home appreciating and us working really, really hard to maintain our credit scores as high as possible, the window of opportunity opened up for us to go into a conventional loan, which is what you want to do. However, to go into the conventional loan from an FHA, we want to make sure that your credit score is a little bit higher to make sure that we maximize that savings for you. Another reason to go from an FHA to a conventional is to remove the mortgage insurance. And this is where it gets really fun. So to give you an example, when we did that refinance and we removed that monthly mortgage insurance, our payment dropped over $300. Now, what becomes really fun is depending on your strategy, if your goal is to stay in that home and just pay it off completely, then maybe why don't we use that $300 to prepay your principal and get you out of that mortgage as soon as possible. Now, if your strategy is not to keep that home, maybe you're going to live there for a couple more years, then keep that savings. Put it away in your savings, invest it in stocks, bonds, mutual funds, whatever you feel comfortable with. And then that way, it goes with whatever your plan is. Now, let's talk about what a seller thinks when it comes to an FHA loan, because when a seller receives an offer, one of the things that they're looking for is what type of financing are you getting? So many times sellers believe that FHA buyers are less qualified than conventional buyers, and that may not always be the case. So it's really important that if you are making an offer, that your lending institution asks that we help and make a call to that listing agent to express how well qualified you are, because not all FHA buyers are less qualified. There are some really good FHA buyers. Additionally, some sellers think that everything needs to be repaired or replaced, so they try to stay away from FHA offers, but that is not the truth. We just need to use common sense. The house has to be livable. If there's peeling paint, they're probably going to get, that's going to get called out. If there's anything that's hazardous or is a safety concern, then we want to get that addressed, but they're not going to ask you to fix every single thing. Additionally, many sellers believe that FHA loans will cost a seller more. Now, that was true. Many years back, earlier in my career, FHA actually had a list of fees that were required to be paid by a seller. But nowadays, that's changed. That changed quite a bit ago. And now the only fee that FHA will require a seller to pay is a tax service fee, which may be $25 to $75. So it's not really going to cost you anything more going with an FHA offer. And last, let's talk about how do I apply for a home loan? Or not for a home loan, how do I apply for an FHA loan? Do I just go directly to FHA? And the answer is no, FHA is not going to talk to you. What you want to do is you want to contact any lender or lending institution that is approved by FHA. Now that is really important. That lending institution has to be approved by FHA in order for them to issue you FHA financing. So there you have it. Hopefully now you understand FHA loans a lot more. And if you found this information valuable, please subscribe, give us a like, and make a comment, and stay tuned as we bring you more educational information.